as a share of GDP, but he's making commitments to increase components of total spending faster than GDP because he wants to raise them as a ratio of GDP. But those numbers, because there is no time scale attached to them, they are risks to our forecast rather than things which we would necessarily build in.
And did you agree with the Chancellor's assessment in terms of, and we're going to have more questions on inflation, but that this was a budget that helps with the government's objective of halving inflation this year? I mean, you forecast it's going to get down to 2.9, I believe. Yeah.
We do, and it's helped in the near term by the fact that the energy price guarantee is extended by 3 months. And so the impact of retail energy prices on inflation is lessened over the period between April and June, because what would otherwise have happened was that retail prices would have jumped from their current 2.5 to 3,000, which would have seen a further big increase in retail energy prices. So extending the price cap takes some of the pressure off retail energy prices in the near term. By the time we get to the end of the year, we're expecting wholesale prices to actually drop below the price cap levels, which means that falling energy prices help to bring down the rate of inflation, as well as other big drivers of inflation that we've seen recently also moderating toward sort of global GDP, global inflation rates.
John, you've got more questions on inflation.
Thank
I know.
you.
Yeah.
Well, can I pursue that theme, if I may? We're just going to focus on the next 5-10 minutes on inflation. You mentioned the energy price guarantee, but I would also add that the fuel duty freeze and some other measures, in total, some estimates suggest reduce the inflation this year by 0.75 percentage point through their direct impact on taxes. Now, I don't want to get into an agreement it's 0.75, but it's of that sort of magnitude. You know, with the war in Ukraine going on, with so many other geopolitical uncertainties, how confident are you that you're going to hit your forecast 2.9%?
Can I ask David to come in on that?
Well, I don't think one can be very confident. It's a central forecast. I mean, just as an indication of how quickly things are moving, just in the last, where are we, the 22nd, the last 3 weeks since the beginning of March, I think the wholesale price of gas, the futures price as it will be in the winter of this year, is down something like 15%, having fallen very substantially relative to the last time we forecast in November. Oil prices are down quite a lot as well. So if we were doing the forecast right now, based on where the futures prices for gas are and where the oil price is, even though this morning's inflation number was higher than we'd thought, I suspect our central forecast might even be slightly lower than 2.9, because the fall has just been so dramatic in oil and gas in particular. That has a big impact, of course, on the inflation rate. But I think that's just an indication of a substantial degree of uncertainty about where inflation will be, even over a relatively short horizon like between now and Christmas.
Okay. Can I push back a little bit on the forecast? I mean, one fully understands the OBR has to make these sorts of forecasts, etc. But I think the general consensus is that forecasts haven't always been, not just OBR, but institutions generally, have often been very wide of the mark. And we sympathise for the very simple reason that you're having to take into account all sorts of factors, including, human psyche when it comes to consumption.
Yep.
But given this particularly challenging period we're in at the moment, we've got geopolitical tensions, we've got supply lines being shortened, we've got a rebalancing perhaps between capital and labour after capital has been preeminent over the last decade or two, coupled with rising interest rates. I mean, the challenge of forecasting has got even greater, hasn't it?
It's very substantial. There's no question. It's been a very volatile couple of years. In some ways, there's always something coming along that you didn't see coming. I think there will be more things coming along over the last couple of years. I mean, COVID had enormous impacts, but more on the real economy and GDP perhaps than inflation. But then, what's happened to commodity prices after the invasion of Ukraine? And it's pretty difficult to forecast. It's part of the reason why, although we are obliged in a sense to produce a single number as a central forecast, I think there's as much emphasis should be placed on our regions of uncertainty and therefore probabilities that the government might hit a target, rather than yes, they hit it, no, they don't hit it, particularly when you're looking 5 years down the road. So, I mean, I very much agree with you. I think making a single forecast and pretending that that's something very precise is not how we should present what we do, frankly. It's a central forecast. Things could be either side of it, and they could be quite a long way either side of it. But it's kind of one's best guess as one can make right now as to what you might call the average outcome across a range of possibilities, which is wide.
I mean, I must admit, at least from my point of view, I think you're on the optimistic end of the spectrum in the sense that I think inflation is going to be much more volatile and higher than many people expect, and certainly forecasters. I mean, from your forecast, you must be pretty optimistic that the Prime Minister is going to meet his target of halving inflation by the end of this year, presumably.
I think there's a pretty high chance of that. I mean, it could be blown off course for sure. I mean, as I say, coming back to just energy prices, oil and gas, which was the single biggest factor for inflation getting up to 10%, which frankly nobody saw coming at the beginning of last year. If one uses the futures prices as the least bad guess as to what might happen, rather than an accurate forecast, simply the least bad assumption. If things play out roughly in line with that, and as I say, since we made the forecast, actually oil and gas prices have gone south of that. They're quite substantially lower. If things were to play out that way, I think there's a very strong chance that inflation would be half what it was at the beginning of the year, because that would still be 5%, which historically in recent terms is quite a high inflation rate.
But if I may interject, Professor Miles, I mean, according to your fan charts, the chances that inflation doesn't halve this year are so remote as to be apparently off the scale. I mean, it's a bold statement, given what's going on, isn't it?
Yes, I mean, if you said what's the chances that inflation is more than half its current level, i.e. more than 5%, I would not say that they are so negligible as to be in the realms of near impossibility. I mean, I think that would not be a sensible thing to say.
Finally, can I just ask this? I mean, it's a little hobby horse of mine, but the renowned American economist Galbraith said, as you well know, that the usefulness of forecasts is to make astrologers look respectable. I mean, you've got so many variables now. To what extent do your models, when trying to, and one appreciates this is a very difficult task, but to what extent do your models actually take into account, or can they take into account, things like, for example, the nuances that have typically been associated with international relations hardening? The supply side lines being short, onshoring, which we're seeing, that's got to be inflationary. An emerging middle class of consumers in millions coming through, and then trying to judge the human psyche when it comes to consumption in the established markets. I mean, those are just some of the variables you have to factor in. I mean, isn't it wise just to say, look, there's all this going on, instead of producing a single forecast, which invariably is wrong, produce a bit of a band and say this comes with qualifications?
Yes. No, I completely agree with you. I don't disagree with anything you just said. And in fact, I'm quite keen that although we are obliged in some sense to come up with what I would call a point forecast, a single trajectory for inflation, GDP, the stock of government debt, and then assert either you hit or miss the target.
Yes.
I would hope that people will pay every bit as much attention to our range of possible outcomes and probabilities rather than the single part. I completely agree with you.
Okay, thank you.
Thank you very much.
If I could just add to that, in addition to what we try and do in the EFO, which is to emphasise the uncertainty around particular drivers of the forecast, and then where we think they're especially important and there's particular uncertainty, we also do scenarios around that, including around energy prices, including around interest rates, and in this case around labour market participation. The other thing which we produce on an annual basis now is our fiscal risks report, where we do try and look into these other sort of deeper, longer term drivers of uncertainty about the outlook. And last summer we did actually look into this question around international trade regimes and where they're headed. And if onshoring, or indeed if a global trade war were to break out and actually countries were to move towards something that looked more like autarky, what would that do to UK trade, UK productivity, as well as that of the rest of the world? So we do try and also emphasise in those sorts of bespoke bits of work where we think there are particular risk factors that need to be better understood in policymaking.
Okay, thank you.
Thank you, John. Douglas.
Yeah, thanks very much. Just on growth, the Chancellor emphasised that the UK is not expected to enter a technical recession in your latest forecast, in contrast with what was said last November. So what, in your view, has changed the landscape around that?
Maybe I can start out, and my colleagues might want to supplement. But it's really that what was a very tight squeeze on both households and businesses' finances that we forecast back in November, from a combination of higher energy prices, more generally high inflation and high interest rates, was I would say somewhat alleviated when we did this forecast. It is still a very tight squeeze on living standards. It went down from about a 7% fall over 2 years down to 6%. So it is still historic squeeze on living standards of households. But because all three of those things had come down since our November forecast, that meant that households had a bit more money to spend in real terms. There was less of a squeeze on business finances, and so you saw less of a near-term contraction in consumption over the course of the first half of this year. And so you just saw in one quarter a contraction of around 0.5%, and then a return to growth, whereas in our previous forecast we were looking at a contraction in output of around 2%, more or less over the whole first half of this year.
Yeah, and what's the most significant part of that then? Is it the fact that we've not entered technical recession, or the fact that household incomes have fallen or expected to fall more significantly and going into the future? So
I think one can get too preoccupied with whether there is or isn't a technical recession, because it really just depends on whether you've got growth happen to be falling in 2 successive quarters. What drives a lot more of what is still quite a tough economic outlook is the fact that living standards are much lower over the medium term.
Right. Have any of the other two witnesses got any comment on that in terms of
I
falling
think
living standards?
I think we're slightly more optimistic about the fall in living standards than we were in November, and it's partly on the back of energy prices again, and inflation looking like it could be quite a bit lower in the near term. Interest rates are a little bit lower than they were. Projections of where the Bank of England's bank rate will be, and gilt yields a little bit lower than they were at the back end of last year in November as well. I think what I described the situation is one where now, for this year, for the year we're in at the minute, the chances are we think that output may pretty much for the year as a whole flatline rather than fall materially, which is what we thought back in November. As Richard said, whether or not we avoid the technical 2 quarters where GDP falls, I think is probably not the most material question, but there has been a change in the near-term outlook for the good.
We had Torsten Bell in yesterday, and he was talking about a toxic combination of low growth and high inequality, and this is what failure looks like. So maybe as an E, we could call that epic failure perhaps. But